for another episode. And today I have some exciting news. We have finally got under contract. We've been negotiating for several weeks on several deals that I've been working on. A lot has been going on. I am feeling like I am drinking from the fire hose. I am putting myself to the max of what I'm capable of doing just to see what I can do. So for one, we've acquired a 165 unit project in Florida and Daytona Beach. So I'm really excited about that. It's a amazing opportunity. And the numbers are just so sexy. I couldn't not. So I'm excited to share more about that with you later on in this episode. If you guys have any questions, throw them down below, of course, about anything you want to chat about. So yeah. Are we connected? I'm trying the new way of doing the YouTube live streaming, which is turning the phone this way. It seems to recommend it that way. It said recommended. So yeah. No, it's existing. It's 165 units. It could probably be 169 units. It maybe at one point was. It's built in like, I think 1979. It's a concrete block construction, beautiful project. We're going to do an extended stay conversion with choice hotels. We're going to do suburban with it, hopefully, and convert so there's kitchens in every unit. So there's nice, it's like an apartment style extended stay type of property where we're going to put some of the best amenities in place and just make it like a really quality B-level project. So it won't be like an A-class asset, but it will cash flow like a monster. I'm talking like 100% ROI. We're talking like 30 cap building. It's in the, I guess if you convert it to Canadian, it's a little over 10 million, but the ARV is 25 million on the project. So there's an insane amount, $15 million in upside. So I'm very excited about that. 15 million in Canadian upside on the project. So I'm very excited about that. It's gonna be a big project, but I'm excited for it. We have the 23 unit that we acquired in Sarnia, which is again, another conversion to be hotel conversion to more of a luxury suite style. So I'm really excited for that project as well. Coming in the new year, we're gonna be closing on that. We've already firmed up on it. Another 16 unit in Florida as well. This one's on the ocean, got beautiful ocean views, 16 apartments. Is I got a couple flips we just picked up, one near Ottawa, another one in Northern Ontario as well. And then we've got a few more projects that are wrapping up. We just closed on another one in Sarnia, which is a house we bought for 90 grand. We're gonna turn around, so I'm really excited about that project. I'm trying to wind down the flipping, and I'm trying to be true to my word and my plan, which is to pivot away from smaller stuff into bigger projects. So it's very much a focus of like shifting out of small assets that waste a lot of my time and don't provide a great return to shifting into bigger assets. And it's part of, practicing what I preach and doing a lot of what I say. And one of the things I've been saying is like, I think real estate is an asset class that gives me a competitive advantage that I can't get anywhere else, any other asset class where I can deliver 50 to 100% return, almost guaranteed. Like we go into a bear market, I can still cash flow the hell out of the thing. As an example, the 165 unit project, we're now going to be acquiring a couple hundred units. So I'm on my way to the plan of 1,000 units, and it's exciting, but there's going to be a lot of work. I'm going to need a lot of help. If you guys know anyone who's a really good kick-ass general manager, COO, we're going to need like contractors, we're going to need project managers. Some of the roles can be remote. It would involve probably trips between Canada and Florida, so that would be kind of fun. Getting the fun in the sun. And it's going to be really cool to watch this grow. This is the way that I make it to billionaire. I want it to be through stocks because I enjoy sitting on my phone like trading, and I still do trading as like a side thing. But I know that the ability to generate alpha, which is alpha is your edge in the market, is really difficult in efficient markets. There's just so many smart, qualified people you're competing against. But in real estate, things are not liquid. So as an example, this building that we're buying is selling at a 2 times revenue multiple. And buildings typically sell at 20 times net income. So like that type of asset, shouldn't have been priced that way. And I think there's tremendous upside. It needs a lot of work, but it's one of those things where when you can find an asset that's extremely underpriced and you can turn it around and transform it, there is significant upside and you're in control of that process. In the stock market, I'm not in control. I can't decide what management does. I can't control where the stock price is going to be. A lot of it's gambling and speculating. You can manage risk, but it's different, I think, in a lot of ways from what you can do in real estate. And for me, I happen to have a competitive advantage in real estate. So that's why I'm pivoting and putting my money where my mouth is. And I think for me, that's going to be a shift and it's new and exciting territory too. I've not taken on projects like this before at this size and scale. And so it's going to allow me, I think, in a lot of ways to grow and try on new things. And that's what I love too, is like trying new things is that's the fun of it. Like doing the same, I've done like 100, duplex flips. Like I've probably transformed 100, 150 properties. It's like the same thing. Oh, $500,000 duplex, buy it, turn around, sell it for 750. Same old thing in London. It just is exciting for me. And like, you can make money doing it. I've lost money recently doing flips too. I mean, I've made a lot of money. I've lost money before. It happens. In recessions, you buy a property, put 25% down, and the market corrects. And if you bought really smart, you end up not losing any money. If the market drops 25% and you bought really smart, you lose nothing. That's what's happened. The market's fallen 30% while I'm doing a bunch of flip projects. It sucks. In some of my cottage flips, some of those markets have dropped 40%. 40% drop in real estate. Things I thought I wouldn't think it would happen that quick. So it's, wow, a lot can happen fast. And it can be a good thing. It can be a bad thing. Yeah. So it needs to be built. No, it doesn't. It's existing building. So we'll be revamping the building. It definitely needs some overhaul, but it's a solid building. We're in due diligence still, so anything can happen in the due diligence period, but I'm going to go deep on it and make sure that it's, a quality asset. So far, so good. Really, really excited about it. Port City is how much? So I said, again, if you can't convert it to Canadian, a little over 10 million, ARV a little over 25 million. So there's a lot of upside in this project. David says, hello from Alberta. Hey, how you doing, David? Port City says, what market is this in? House sub 1 million, multi-unit there, question mark. How many units could you get for $1 million? It just really depends, right? Like, well, Florida's also like 6 different provinces all in one. Like the panhandle of Florida is totally different from Central Florida, which is totally different from the East Coast, which is a totally different vibe from, West Coast Naples, which is even still different from the Florida Keys or like even Miami, right? So there's just, all these markets are so different, right? The Everglades is totally different from the Panhandle. And like Jacksonville is totally different from Miami, even though they're on the same East Coast. They're so different. The culture, even within Florida, is so different between these different cities. And I've spent time in almost every city in Florida now. And I took time going all the way around Florida in a circular shape to try to see real estate in all those markets so I could really become somewhat of an expert to understand that market. And again, I still have a long way to go before I'm a complete expert, and there's always gonna be more to learn and more to do. But yeah, I'm really excited by the fact that, to answer your question, in the Panhandle, they have, and I don't own any properties there, and I have no intention to buy any properties there just because it's so rough and vacancy rates are so high. But they have, I've seen like a 50-unit hotel for like, 50-room hotel was like 1.5 million, super cheap, like 30,000 a unit in some of these areas where you can get really, really cheap stuff, like a triplex for 100 grand in certain areas of Florida. Now they're not desirable areas. In the more desirable areas, you're going to pay premiums. So like, if you're in like Jensen Beach, Port St. Lucie, West Palm Beach, you're going to pay 150 to 200 grand a unit typically. If you go further south towards like Fort Lauderdale or like some really, really nicer areas in Miami, you can pay upwards of 200,000 units. Sometimes if it's really nice near the ocean, $250,000 a key or a unit. You go to Naples, you'll pay a couple $100,000, a unit typically if it's really nice stuff. If you get some of the crappier stuff, as you get more north in Florida, it gets cheaper. So the more south you are, the more expensive the real estate is. The more north you are, typically the cheaper that it gets. However, the more like northwestern towards the Panhandle, you get really, really cheap as far as like price per unit, but revenue is significantly lower. And so not only are the cap rates are really good there because again, the clientele is bad, well, not bad, but not as good. And, in the Panhandle of Florida, you're also in Central Florida, you're gonna get a lot more damages and rougher, quality of tenant and higher vacancy rates, and all of that factors in to the math, right? And at the end of the day, does it math? And that's the real question is like, I'm only buying things in Florida that are close to, major cities. I just don't want to be in a small city. I just don't have an interest in that. So for me, I got to stay in somewhere that's growing. So I pick a city that's in the top 10 always. I want to see a fast growing city that's, future growth potential, that doesn't have a high vacancy. It makes it easy to operate a business in a city that's growing with a good, healthy rental market. So those are the things that I look for in markets that I'm investing in. Did you buy? Yes, I did. I definitely did buy that one. Yes, it's a great deal. I'm happy about it. We're going to be able to make a big lift on that project and starting in there. Martin says, congrats, Mike. For larger buildings, are you finding these off-market? Any tips on finding off-market multi? There's a mix. So some stuff I'm finding on market. There is stuff on market. As an example, one of the ones we bought is 40% off the list price. Sometimes people will sell for significant discounts. That was 35%, 40% off the list price in total, and got seller financing at 3% on one of the deals. It's like that kind of stuff is where creativity and the nuance to the deal can make all the difference. And sometimes you think a seller won't go to a certain price, but they will. Sometimes you see a house listed for 300, you throw an offer out for 190, and they'll take it. It's crazy, right? Like everyone, you look at, I have students who I've coached who like, there's nothing in the market. And I'm like, how many offers are you throwing out? They're like, oh, one. You throw out one offer. How do you know what sellers are willing to take then? You haven't thrown out 100 offers. You don't know. You need to be out there pounding the pavement, throwing verbal offers at people, seeing what sticks. Some sellers are desperate right now and they will take low amounts of money. Some are like me where, maybe they're cash flow negative on some of their properties because they have high rate mortgages on them. I have some stuff that was variable that doesn't even cash flow now. And it's like, I need to dispose of that stuff and focus on large multifamily. I could hold it too. Like I can also pay off the high interest debt using cash and just hold it out until, things turn around and pivot. As soon as rates start dropping, like, oh, I didn't even cover this. Guys, FOMC meeting today, the Fed spoke. Jerome Powell dropped his hammer, and then there was no sound at all because it was like he was going to drop the hammer, but he's like, no, dovish meeting. And bond yields yields in general are just falling right now. Mortgage rates are falling. I think we had like a 5% drop in mortgage rates just after he spoke. He basically said, I think it was dovish. He said a couple things. One, he said that there's a lot of pain in the real estate sector right now. As notes start to roll over, we're going to see more and more pain, which is like, for me, that's like, giddy up, let's go. That's exciting. I want to see that. And I knew that was coming. We all knew that was coming. More pain is coming to the businesses and to the real estate owners and all of that. Again, because they had notes at 2%, 3%, 4%. They're now renewing into 8%. And when your interest payment is double now, that has an impact on your bottom line of your business. If you have a big, heavy inventory business, you're going to feel that. It's going to cut into your margins somewhat. If you have a real estate business, again, real estate's heavy on the asset side as well. And you need a lot of capital. It's a capital intensive business. Those businesses are going to struggle right now. But what he really said was that one, we didn't get another rate hike, which is like, okay, the market was already pricing in that we weren't going to get another rate hike. That wasn't probably going to happen anyway. But more interesting and almost scary in some senses, I think it's dovish, is that he said he keeps saying data dependent. But interestingly, like the dot plots that they draw every time and the predictions and the forecasts they have for the economy are wrong. Every single time they're wrong. They have such bad accuracy and they're so bad at their jobs that like, I think that's dovish. Because when they say, hey, we're not going to cut next year, they're tough talking to us and we can see right through it. Pain is coming. They're going to cut. The pivot is coming. By summer of next year, it will start. That is my forecast. I think August of next year, we're going to start seeing a pivot in the Fed rate. Fed fund rate is going to drop, which will drop mortgage rates, which will, again, be a huge amount of euphoria. Now, what I hope is that they do it slowly and they're careful about it. As soon as they start dropping rates, hopium is back. Everyone's got a lot of hope. They're going to start investing in things because, again, all that trend down is good. I would prefer that than, like, I want it really nice and slow, and I'd prefer to know when that's going to happen. I wish the Fed would give us guidance. They can't, though. Their job is to be hawkish and to keep inflation down. And so to keep inflation expectations and price stability anchored, they need us to believe that they will not pivot. And so when they do want to pivot, they can't tell us until they do it because that would defeat the purpose of them being tough. So they have to say and be dirty to us, talk dirty to us and say, hey, like rates are not coming down anytime soon. Because if the customer or the spender or the consumer's expectation is, hey, rates are not coming down, I better save, I better not spend. And so that would cause inflation to fall. That's what they want. They want people to hold on, start saving, stop spending. And they want people to be more careful with their investments, right? And like pull back, and that will cause inflation to drive down. They want to drive, they're attacking demand side. They're doing nothing for supply side other than probably constraining supply side, at least to some extent. Also interesting in the past week, big government and the Fed, like the Bank of Canada or the, Jerome's, whole group of cronies, they're at odds with each other. And the thing is this, big government just like, Biden administration, they're printing money. They started issuing bonds again. They're raising capital to cover the cost of debt. Something like, I think coming into about a third of the annual spending, including healthcare, military, everything, is going to be just interest servicing the debt the federal government has. If we stay at these levels, tax rates get so high, we have revolution. So something will break. The financial system will break, the real estate market will break, businesses will break, The consumer will break. Credit card debt is up 20% on the year. There's a lot of things. They're like, and you're like, Mike, that's bad. That's actually good. We are very close to breaking. And when something breaks enough, inflation falls, rates fall, party time. As soon as the Fed pivots, we got to go in hard on assets that are, tied to interest rates, which is real estate is one of them. Pretty much every stock really is, using some extent of leverage. And so in general, the stock market, though it will be painful initially, we might have a lot of choppiness, a lot of volatility in the next 6 months, ultimately leads in a W. So it ultimately leads up when rates start falling. So there will be some choppiness where you might have like a 10% pullback, but then it's going to rally. So that's what we need. And that's what's coming. It's very close. I'm now sure that pain is coming. And I'm actually bullish about the pain that's coming. It's actually a good thing. We need that relief. It's just how resilient is the American and Canadian business? How resilient is the average, person's savings? When they are depleted of savings and when the pain starts, the rates are done. So I guess that's the question, is how much more is there? And I'm telling you, having talked to a lot of accountants that are doing a lot of books right now, people are struggling. People are struggling. The market sentiment right now that I'm seeing, all the data is that people are struggling. What's interesting, though, is that a lot of these unions are negotiating insane. Like if you saw United Auto Workers, deal with GM and Ford, they're asking for like 25% pay increase, I think, over 4 years. That's insane. They want insane 25% increase in salaries may cause a price wage spiral. So if we see more of that type of thing happening, now, I mean, the United Auto Workers tend to be overpaid anyway, and they've had a lot of years of they need to catch up on that. They used to be really overpaid, and now they're not as overpaid. Now they're probably closer to market, what they deserve. They're going to get a big bump. And they've, it has to be they have to pay a certain wage to drive, demand, I think, for that profession. And there's a lot of people that don't win the blue collar right now. So I would say that, will that drive inflation? Potentially. And so we got to think through those ramifications, things like that. If that continues to happen, where wages actually do spike, okay, then we have a new conversation about potentially higher for longer. We are higher for longer. I've been calling for a year that this was never going to come down in 2023. I know a lot of real estate gurus and guys I followed on Instagram were like, 100%, 2023 November, rates are falling, like guaranteed by January 2024, all good. No, definitely not all good. Rates will take longer. It's just my forecast happens to have always been mid to end of 2024. And again, it still is mid to end of 2024. This is the time, though, to start qualifying and grabbing those assets up when it's hardest. It's really hard to raise capital right now. It's really hard to borrow right now. It's really hard to find, stuff that cash flows. That's a good sign. That's when you want to start acquiring these assets, when they don't make a lot of sense. Because again, during the next market, when they start to make sense again, then they really start making sense. So, okay. DC said, hey, Mike, how many Airbnbs can you legally own in Ontario? Just your primary rented max. I don't know if there's a law in Ontario per se against Airbnb. It's a municipal thing. So certain municipalities have banned it. In London, Ontario, you're allowed to rent your primary residence, guest unit out. You're allowed to rent your own house out for a certain amount of time. They don't crack down on this very hard though, because I know a lot of re-rental guys in Toronto, Vancouver, London, Ontario, who are doing the re-rental strategy, who are renting from landlords and then subletting. And when the landlord gets a notice, they say, what do you mean? I rented it out long term. The tenant is re-renting it. There's no block on that. So there's people just go around it and they do whatever they want anyway. So like you rent it to your friend and your friend can put it on Airbnb and you're like, what do you mean the tenant's doing that? I have no control over that. I'm not putting it on Airbnb. I'm in compliance. So like there's a lot of that going on where like people just do it anyway in different ways. And then there's also just people who just do it and there's no repercussions. Like they're not really hounding. I'm not looking at small time stuff. This is why I want to go to big stuff. When I buy a motel or a hotel, I have a license. And you know what's beautiful about a license like that here in Ontario is that when I'm doing guests like that and I have a bad guest, call the police, GTFO. They have no rights. They have no power. That's a business I like because I can control revenue. I have no long-term tenants. I have no bad tenants. I get a bad guest, they're gone. Done. Motel license is super, super powerful. So I love the motel hotel play. In Florida, same thing. You can jack the rents, whatever you want. You're in full control. So what I want to do, my plan has been communicating this to guys. My strategy is going to be this. I'm going to buy motels and hotels that are run down. I'm going to convert them. Hopefully I find ones that already have kitchens in them. It's even better when they do. But I'm going to revamp them, make them look really cute and nice. You can do these micro units. They're like 200, 300 square feet that look sick. You can do like nice sliding barn doors, really high-end granite. You can make things look really, really nice in a small space that it's a really nice furnished apartment, and people will pay 20 to 30% above market rent for the right to have a fully furnished apartment. And a lot of these longer term guests will pay weekly or monthly at great premiums with consistent rent, and then they're not tenants either. That's a really cool thing. So that's what I'm gonna be focusing on. The reason for that too is that you can buy motels, hotels, and that sort of thing at extreme discounts per unit. So you can buy this stuff at as an example, 165 unit at $44,000 a unit. Market comparables are $120,000 a unit for multifamily. It's $160,000 a unit. So there's a 400% difference if you can convert that asset from a motel, hotel that's risky to something that's stable with consistent revenue every single week, servicing a long-term clientele. So that's my pivot. That's what I'm going to focus on. It's a niche I found in the market that's going to work really, really well. And I'm excited about it. That's where I can build a business that's predictable and sustainable, and I can grow it. Whereas in the residential space, in Ontario at least, you don't have a lot of control. You get student rentals, you have control, as long as the tenants turn over. But if you're putting in long-term tenants, they're gonna be there for the next 5 years, you're stuck as inflation potentially runs higher than the rent. And let's be honest, like inflation might be 2%, but it's really like 10%. The shadow inflation is much more dramatic. As an example, in the last 7 years in London, Ontario, rents have moved up 100%, over 100%. Your cost of shelter up 100%, food up 40, 50% over that time period. And they're saying, oh, inflation's been 2%, inflation was 7%, whatever for like a year, it's transitory. But like, let's be honest, like inflation's a little higher. Another reason why you want to own assets with leverage. You want to buy a building, put 25% down on it, make sure you can borrow 75% loan to value and have surplus cash flow, lots and lots of surplus cash flow. And then if rates do go higher, make sure you stress test it so you can service those loans. If rates do, double, run your numbers. Can the building sustain at 1.5 times 150% of current rates? And rates are already pretty high. You run those types of sensitivity tests, and some properties, the ones I'm buying at least, they do. They still cash flow. And so it's like, for me, I'm buying assets that are recession proof, that if inflation does run wild, and like if the Fed does cut too early and they cut too fast, we could see a resurgence of inflation like what's happened in the 70s and 80s. Now, this time is different because, again, in the 70s and 80s, we didn't have AI bots and the internet and social media that allows information to disseminate quickly. So people have TikToks and Instagram reels about things that allow information to travel faster. So cycles over time are getting faster and shorter and shorter. That's a good thing because recessions don't last as long. It won't be as painful as it was then. It might be more dramatic actually because people will panic and they might oversell and overbuy, and so you get more euphoria and more fear faster, but things happen quicker, and that can be an advantage. In general, my plan has always been to acquire lots of assets that produce great cash flow, leverage those assets to buy more, and over time, if you own an asset, if you borrow from the bank at 5% interest, and over the next 5 years, we have 5% inflation, you borrow money for free. I'll just repeat that again for some people who might be a little bit slow. I talk quickly. Say it again. If you go borrow right now, take out a note at 5% interest, 5% interest right now, guys, and for the next 5 years, we have real inflation of 5% a year, then you've paid nothing. When you pay back that loan in 5 years, if you pay 25% in interest, again, you've paid nothing because the buying power has changed by the exact same amount. So that's what you want. Over a 25-year period, these assets will grow massively in value while the mortgage stays the same. So the building you bought for $1 million in 25 or 30 years is worth $3-4 million, but the mortgage note is the same or paid down. So over time, you get a bigger gap. What you want to do, though, is as this is growing, you want to re-lever. Borrow more debt, take that, buy another asset. Now you have 2 assets. So your total assets under management continues to grow rapidly because you refinance these assets as they build equity over time, and you buy more. And that's how you get from 100 units to 1,000 units to 10,000 units. Over a lifetime, if you're a serious real estate investor over 30 years and you haven't acquired 10,000 units, you didn't take it serious. I mean, everyone, if you spend your life just acquiring a building a year over your whole life from when you're like 18 to like 70, by 70, you should have like 10,000 units. That's just, as long as you took it seriously and you tried to do a little something every year, I mean, it's just natural. If you bought the right kind of quality assets, you'd be okay. And if the cash flow strongly and we go through a recession where prices fall short term, because over the long term, it might look like this. The price of real estate will look like that, kind of like a volatility, like a stock chart. And there'll be years where like you bought here, you bought said asset number 6 here and then a couple of years where it was down. But over the long-term trend, it looks like this. So you look back in 10 years, and over 10 years, you're still way up. And you didn't have to sell during these downtimes because then you bought cash flow positive assets that generate enough to service all the debt. That's what you want. That's a really resilient portfolio that you can retire on. And what I like about the large portfolios too is that, like, versus a small portfolio, I have property managers, I have no control. The large portfolio, I can hire a COO, I can hire an assistant, and I can hire a good property manager, all in-house. And I have a staff of people that are solving all the problems for me. And if you're good at building systems and hiring the right people, which I'm looking for the right people, if you know someone who wants to run point on helping me grow, I need acquisitions people, I need management. That's a big sore spot right now, is like, we're outsourcing management and I want to in-house it at some point. And that would be smart to bring a key hire on. Like, I could pay 50, 100 grand a year for the right person to just run things and be like a general manager of these projects. That's something I don't want to do anymore. But if I build the right systems and the right people, it runs passively. More passively in some ways, with better control and better ROI than if you were to invest in a REIT, or if you were to, invest in some small properties. Small properties are a pain. You don't have economies of scale. And so you're stuck with, like, if they take you to the landlord tenant board, you're stuck dealing with that. Or if there's like a problem with your management, you gotta change managers, it's a lot of work. Whereas if you have a big business with a lot of staff and someone leaves, you're okay, you can plug and play other staff. So getting to a large size of scale actually makes it more passive. I know it sounds counterintuitive, but like, I need to get to a size where it's actually passive. Because when you're small, you don't have scale to make the business passive. So that's my goal right now, is to build out something that's really robust and passive. And the fun thing is, like, you guys know my long-term triangle goal, where I want to set up like a mastermind group of like the coolest people, the coolest, families and dudes and girls to be part of this Freedom Collective. And between, maybe it's Costa Rica, maybe it's the Bahamas, Florida, and Canada, I want to go between that triangle. And when the weather's the nicest, we go to those areas that are the best. So as an example, summertime in Canada is phenomenal. I've always traveled to Canada in the summer. Cottage country is amazing. It's one of the best places on earth. Some of the cleanest, freshest water. But Canada sucks shit from right about now until like May 24. So you didn't want to be in Canada during that time. Plus, Canada's tax system is horribly broken. It's like 55% tax. It's brutal. You can get offshore setups where you pay no tax at all. You can own your real estate in Canada and IP being in, say, Bahamas, and effectively pay no tax. You could bleed all the IP revenue back to the Bahamas with 1% tax and avoid tax almost entirely. I've talked to a lot of professionals who are doing this, and it's like, I haven't figured out the exact structure yet, but everyone I'm talking to has gotten their tax burden down to like a 10% average, which is phenomenal. You don't want to be a Canadian tax resident. Canadian passport is cool, but Canadian tax resident, nah. I'm moving towards away from that. This goes well with that vision, because again, I'm going and checking on my buildings in these 3 locations, and we're having masterminds, and we're celebrating and growing together. That's part of what I want to cultivate. And having a business that it's going to generate 8 figures in revenue. And when it's got 8 figures in revenue and hopefully 8 figures in appreciation, you get some real capital to work with where you can really have some fun. Like, that business could afford to have a private plane, as an example. And that's just something like the next level luxury. It's just fun. And so that's what this is about, is like just growing to see what I can do. And so that's why I'm doing it. It's just like, because I can. And because I want to prove to myself that, I am someone who could do that. I could be a billionaire. Now, it comes to sacrifice. I'm going to have to sacrifice. And the last week, I've been sacrificing a lot. I've been on my phone probably 10 to 12 hours a day working on these deals. I've been on the, texting and doing due diligence. And you're talking from like 4 or 5 financing companies at once, your insurance due diligence, contractors, all of that stuff you have to do, negotiating with back and forth with sellers and realtors and, contracts and lawyers and all of that stuff. You're on the phone for hours, back and forth. It's almost like a business sitcom or something, like Suits or Mad Men or that kind of thing. And it's exciting and exhilarating. And there are parts that suck. A lot of parts that also are stressful and suck too. But nothing worth doing is easy. And the payoff is definitely, I think, worth it in the end. And I like to know that any time, if I get big enough, anytime I can put in good management and step back, I would not grow as quickly for sure. Like, the number of units growing each year would drop significantly. Like, let's say I get to 1,000 units and I just stop at 1,000 units. There's no reason that every couple of years I couldn't refinance that 1,000 unit portfolio and pick up a couple hundred more units. Or just stop and pay down those 1,000 units, right? Because every year you pay down some of those debts. So it's like, over time, you eventually own 1,000 units free and clear. That would be horrible ROI. Ideally, you'd refinance and buy more buildings. But because again, the same philosophy in large applies to small. Would you rather have one house fully paid off, bringing in $3,000 a month in rent? Or would you rather have 5 houses at 20% down? It's the same amount of money to own 5 houses with mortgages on them, or one house 20% down, each one is 100%, or one house owned in cash. One house owned in cash will give you $1,000 a month, $1,500 a month in cash flow. 5 of them might give you $500 a month each in cash flow. So you're looking at way more cash flow, and not just cash flow. The real thing is about pay down and appreciation and tax depreciation. But the appreciation on these 5 over time, when this becomes worth $1 million, these 5 are worth $5 million. And if when you bought them, it was half that price, your mortgages stay fixed as these assets appreciate. You have way more assets under management and the debt stays fixed. There's a huge amount of spread. Over the long term, you win big with leverage. And again, the secret to not blowing up me and Dave Ramsey when it comes to leverage is buying quality buildings that produce significant amounts of cash flow, copious amounts of cash flow to more than service the debt for you. If you can't borrow that money and that asset can't cover it, get rid of the asset. That's what it is. Stewart's a beautiful area, definitely. Competing with Grant Cardone's in Florida. No, I don't think Grant Cardone's going after assets like this. This asset needs a lot of stabilization. Maybe the Ben Mallas of the world. I would love to meet with him, and he's an expert, and I have a lot of respect for him. He's a funny guy. I've watched some of his content, and eventually I will get to that same level for sure. Like, it's inevitable that I also become, at that level of Ben Malla. Randy Jas says, hey Mike, can you share the basics of how you evaluate multifamily in terms of minimum financial criteria, cap rates, minimum ROI, minimum cash flow per unit, deal breakers, deal makers? Thanks. That's a lot. It's a loaded question. That'll be a whole episode right there. And I haven't prepared to answer all those questions, but the general rule of thumb is this. I like to buy multifamily properties that have a large value add component. So if it's completely turnkey, it doesn't typically fit my metrics. Now, there has to be some, it has to have be dated in some way that I can do a refurbish to it. There has to be a lift along the way somewhere. Something I can do to improve the building. Ideally bad management too. I like to buy buildings that are poorly managed and that have the opportunity to drive revenue up and expenses down. So that's what I look for when I'm looking at buildings. Another thing is just in general, I want a certain amount of ROA, or return on asset, or cap rate is another way to look at it too. But generally, I want the building to perform at a certain cap rate that's high enough to justify these rates right now, and even more juicy when the rates do fall next year or the year after, type thing. So typically what you'd want is to see, let's say your borrowing right now is 8%. In the US, it's 8% to borrow right now, best case scenario, maybe even 9% for commercial. Some loans are 9.5%. So 9% you're borrowing at, these assets need to be at least a 10 cap, which rules out about 3/4 of all multifamily in all major cities. So you're then already, your screening drops significantly, and only a few assets actually meet those metrics. Nothing in Vancouver, Toronto, LA, in Miami, none of those places works because the cap rate just isn't strong enough. So that's a challenge, I think, right now, is that a lot of these buildings don't meet these metrics. But if you can buy these buildings that produce really quality cash flow and that have that upside lift, over the long term, you can grow really quickly. Depends on your goals too, right? If you're just trying to park money and retire and live off that money, that's different, right? Then you can buy super turnkey, really nicely renovated, the nicest properties. My properties that I buy tend to smell, tend to have problems. I'll walk in, I'm like, these drapes are horrible, this bedspread's bad, I can see cracks in the floor, the flooring's horrible, I look in the shower, there's mold, guests are complaining, bad management, I look at the revenue, the ADR, and I see ADR is shit compared to the area. I see, all those things I'm looking for are good things. So long as I can take that asset and turn it around. I have to be confident in my ability to be able to do that. So it has to be potential. I'm a sucker for potential. I love potential. That's what I look for in my properties. And there's probably way more that goes into it than that too. It's all circumstance and deal negotiation too, Randy. So how do I explain that? If someone came to me and was like, hey, I have this turnkey building that meets none of your metrics, but I'm offering you 3% seller financing for the next 5 years. I'd be like, all right, let's talk, let's do a deal. Because if they'll subsidize me for the next 5 years to take this asset on, I get all the appreciation for the next 5 years and all the inflation for the next 5 years. They're gonna effectively lend me at 3% a year. Over 5 years, if inflation over 5 years is less than 15%, I would be shocked. I think inflation is gonna be probably, over the last 5 years, in the bull market where rates were 2%, inflation was 2%, we saw rents double. Right? We saw real estate prices go up 200% from 2015 to now. It's a 7-8 year period. Things shouldn't be doubling that quickly when inflation is 2%. Because newsflash, inflation isn't 2%. When they say it's 2%, shadow inflation is really 300% higher. But whatever, they manipulate the basket of goods. It's the CPI, not the CPI. I'm getting down the conspiracy rabbit hole, but if you actually look at some of the data, they do cherry pick it to make it look better than it is. And rents in London, Ontario, in Canada in general, have more than doubled for the last 7 years. So you can do the math. What is 120% growth over 7 years per year? That'll give you your housing inflation, which is, again, half of what people spend their money on. Yeah. But for some reason, they don't weight it 50% in the CPI basket. That's weird. They don't do that. I wonder why, because it doesn't benefit them. Gran says, Mike, did you build your deal flow, or how did you build your deal flow? So a lot of it's just pounding the pavement. Like, that's what I'm doing. I'm on the MLSs. I'm on, your Crexys, your LoopNets. I'm on your Realtor.ca. I'm on Facebook, Kijiji. I'm talking to property managers. I'm talking to wholesalers. I'm talking to as many realtors as I can, planting seeds. I will call, hey, I found this building. You can also just go in your city. Like, if you like a certain city, you can map out every single building in that city and talk to every single owner and just know them all. And if you know them all, like some small cities, like even in London, in like 4 months, you and an assistant could map out the entire city, every single multifamily building that exists, and then call all of them, reach out to all of them. Once you know them all, then you know the whole market. You can then go, landlord by landlord. Hey, you want to sell? And call me when it's time. And you can build out a really robust deal flow by cornering a market, becoming an expert on that market, and know all of the inventory in that market, on market and off market. And that helps you become an expert. And then when things pop up, you can move very, very quickly. Panhandle is basically Alabama. Yeah, true. A little bit. I don't want to throw any shade, but Panhandle's not for me. Port City says, have you heard of the DJ Envy guy who scammed his investors raising money for properties he already ran out and sold off? No, I haven't heard of that. DJ Envy, is that a real estate guy? Sounds like it's crazy. You gotta be careful out there, guys. There's a lot of funds out there who are raising capital. They have these mutual fund trusts, and they have these REITs or these, small operative, agreements that are effectively like REITs. They're even in compliance and legal, but they're out there and they're scamming their investors. And so I just be careful out there. There's a lot of really bad actors in general in business. So just do your due diligence, guys. Do your due diligence. Be very, very careful on who you work with. A lot of these guys will show up for a year or two in the bull market, and then they'll disappear in the bear market. There's a saying that I like. I've been investing in real estate for 12 years now, and I'm not going anywhere. And there's a saying I like, and it is that when the tide goes out, you see who's swimming naked. And the tide is going out right now, big time. And you're seeing a lot of developers bust. You're seeing a lot of people who are swimming naked. And they're people who honestly, a lot of these people don't have good business sense. They aren't smart people. And real estate attracts a lot of that. Part of what I like about real estate is the mom and pop aspect, the unsophisticated investors that are drawn to real estate. Your plumber, your whatever, your random person you meet. You got your hotel owner who owns one hotel and it's the whole family's business, and they're just horrible investors. Maybe they're good at running the hotel, but they're just not great investors. And so if you can go in there and you can offer some sort of additional edge or some value to them, emotionally you can appeal to someone, you can get really great deals. And also you can beat your competition really well when you apply certain, strategies that maybe they aren't thinking about. And some people just don't think at that level. It's just, they're just out there trying to run their stuff. They're not marketing well. They don't have a good design taste in their units. They don't put the money into the buildings. They're cheap, and it shows in their net operating income statements. So yeah. I just hope you're well. Do you use any landscaping companies for your properties? No, I don't use any landscaping companies. I have a grass dude who cuts grass. I do have like a guy who will help out. Some of my contractors on our flips will do, and my partners and stuff will do landscaping, go buy some bags of mulch or whatever and put it out. In the winter, it doesn't matter, but in a summer or spring sale, landscaping matters. Port City says, Canada's screwed. We don't hike. CAD falls to probably 0.65. If we hike, Canada goes into recession. TIFF needs to be fired. Yeah, it's a real challenge actually in Canada. So we have higher inflation than the US. If you look at the Canadian dollar, it's been doing horrible relative to the Costa Rican colon, the Mexican peso, the US dollar. Against the peso, the Canadian dollar has lost 17% in value. Against the Costa Rican dollar, it's like the colon or whatever, it's lost 15%. Against the US dollar, we've lost 14% in the last 2 years. Canadian dollar is just doing, Canada's under such shit management, it sucks. I wish I didn't have Canadian net worth, most of my net worth in Canadian dollars. Thankfully, I have some in other currencies. I'm thankful I have US exposure in my stock portfolio, etc. But yeah, it sucks. It really does suck. it may get worse, to be honest. I think that, again, there's real risk there with the Canadian dollar right now. And part of why I'm divesting, well, I'm still investing in Canada, but I'm divesting some of my portfolio outside of Canada is I don't want all of that risk. Now, there are ways to hedge against that. You could go buy futures right now or buy hedges right now against the Canadian dollar falling if you're worried about that. Like if you're going to go invest somewhere, you could protect yourself against that. There are contracts that exist for that purpose if you wanted to lock in. But then you're going to lock in at today's price, which is like, I think it's $1.39. Every dollar of American is worth $1.39 Canadian. It was $1.25 like a year and a half ago. So a 14% difference. And more recently, in the last month, I think we've lost 3% to the value relative to the US dollar. It was $1.35 something, now it's $1.39, almost 4% or 4 cents, I guess, difference on every dollar converting CAD to USD. So that's substantial, I would say. Yeah. And it stems back to really, really bad management practices. Justin Trudeau is a clown. I don't want to throw too much shade, but like he is the most unqualified, and most of his cabinet is the least qualified I've ever seen for just running an economy. Forget, maybe they're really up on like, they legalized weed and they're all about like the trans and LGBTQ. And I get that they're like, he's hip and modern and good looking and whatever else, right? Like he has those things going for him. But things we actually need him to understand, like he says the budget balances itself. What? He's like, yeah, what was his saying? It was like math dyslexia or something. He basically has a number dyslexia where he can't even understand numbers. He literally isn't a math guy. He just has no understanding of that. The problem is I talked about this earlier, but the government in Canada is printing a ton of money when we need them to be cutting spending to drive. If they keep printing and they keep giving money out to people, they're talking about universal basic income in Canada right now, giving everyone, I think, almost $2,000 a month cash. They're talking about rolling that out. That's a bill coming out. They're offering incentives for, like, if you have a child in Canada, you get $600 and something cash tax-free in your account. If you have 5 kids and you live in Canada, you get a lawyer's salary after tax and cash in your account just because you have kids. They're just printing billions and billions of dollars, just handing it out. And when you do that and you hand a bunch of money to people, what happens? They spend it. It creates inflation. And then what happens when you have a really, really resource-rich country with a lot of, we have tons of minerals, oil, lumber, whatever, like we have all of that. And then you block pipelines and you focus on green initiatives. And then guess what? The pollution just happens right south of the border. You do fuck all. All you do is screw our economy over. Guy's an idiot. It's been a decade almost of this clown, and Canada has not done well under his management. And it's a shame because Canada really is, we have so much raw potential. Canadians are well educated. We're kind. We have amazing natural resources, some of the most fresh water, some of the biggest land mass in the world, and good quality land for farming, good quality land for forestry to harvest. We could have a plan where we're replanting everything that we take out, and it would still be very, very sustainable, and we could drive a ton of GDP growth. Right now, number one leader of GDP is real estate in Ontario. It's the number one driver of our GDP is real estate. And real estate just crashed 30% in Ontario. So what is that going to mean for all the services and goods related to real estate? It's not good. That's what it is, not good. His plan is immigration. That's his only bullish thing that he's doing for Canada, is he's like, we're taking in well over 1 million immigrants than even he thought he took in. They can't even keep track of how many people they're taking in. It's so bad. And then we have a housing crisis, so that's also good for real estate. But in general, Canadian dollar will do really well when Pierre, the leader of the Conservative Party, wins. And he will win. I think something like 75% of Canadians hate Justin Trudeau and would not vote for him. So 3/4 don't like him. He might be able to turn things around and buy votes by giving more money away, which leads to more inflation. I don't think Canadians, I think Canadians see through his bullshit. And I don't like to get political, but it matters when we're investing, and the political climate matters, and it sucks. Because I think Canada can make a really good pivot, and I think under Conservative leadership, there is a possibility that the Canadian dollar gets very strong again. And if it does, and we risk another election, and the NDP take over, or some socialist nation, I'm going to be fleeing Canadian dollars into USD, into colones, and different currencies, into Bitcoin, and into gold. I'm going to steer out Canadian dollar if it recovers. Not right. I don't know if now is the best time to do it. I'm taking some, putting it into USD projects just to have that diversity. But yeah, I really hope things change. Bum, 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 bum. I think I missed that. Congrats on the, thank you. Buying a property from a wholesaler, what your due diligence checklist. I mean, the same you do from your buying from, on MLS. All the same things you're looking at to evaluate the deal. You do it with the wholesaler. With a wholesaler, you might check everything twice because they don't have a fiduciary duty and they don't have any integrity. A lot of them don't have any integrity. So just be careful with that because realtors are bound by certain rules and ethical obligations not to lie to you. Whereas a wholesaler can just lie to your face. So just check all the facts, make sure you do due diligence. Yeah. Mike says, what do you do with real estate that no longer cash flows? Well, you have a couple choices. One, you could dispose of that asset. Two, you could find a way to pivot that asset. So maybe right now it's a single family and maybe you could finish the basement, make it a second apartment. Maybe there's a way you could rent it by the bedroom to students. Maybe you could put it on Airbnb. Maybe there's a way to pivot that asset to make it cash flow. That's the first thing is like, how can you change your strategy to work with what you've got? But if you can't work with what you got and there's nothing you can do and you're stuck with high rates, you have to decide, am I going to put a loss of X amount of money per month to cover the difference in this property as it cash flows negative until rates fall? Or are you going to cut the loss and buy back in later? What I know is this, time in the market tends to beat trying to time the market. So just being in the market, owning a property over time, 10 years from now, that property will be worth more than it is now. Hopefully outperforming inflation. Again, there have been periods in time where that hasn't happened, but majority of the time, over a long extended period of time, you will win over the long term. So now's a pretty shitty time to sell. I would say there is very, very low demand for buyers in general. Many can't qualify. It's a real problem. So be that what it will, selling is not a good idea right now. As I say that, like I'd probably hold till the spring and see if things improve in the spring. In the bull market of the spring, you might be able to sell your property for 10% more than selling it right now. That said, I have like 12 properties that I need to sell off. I have cottage flips we just finished that I need to sell off. And it's like, it's the worst timing possible. So if you want a deal, hit me up. I don't care. I'm willing to take the loss. I don't want to hold till the spring. I can take that capital and I can double it in this time in other projects. Some people can't. Like maybe if you don't have a lot of opportunities, waiting till the spring isn't a terrible idea. Chuck says, where do you get your real estate statistics from? For example, how do you find out how much home prices have increased in the last 5 years? So one of the places you can go is Google and like just Google and all the local real estate boards will post for each local area. There'll be reports for all of Canada, all of the US, your local markets. All that information is on Google. You can find that. Asking the right questions on Google will take you to the right places. Verify where you're getting your stats from. But yeah, I also am a realtor. And so I have access, at least in Ontario and in Canada, to all the available data. I can see what things are selling for on a weekly, monthly basis. I can see every single sale. I can click into each and every one. So I have access to all of that data because I'm a realtor. That gives me a slight edge in my local market. When I'm investing in Florida, I get the realtors I'm working with there to pull comparables for me so I can see everything that's sold. But yeah, you have to look at the data and it's important. I know a lot of people don't like to dig into the data. It is important to at least skim over it to make sure that you're doing your due diligence. That's how you know it's a good deal. Is it a good deal relative to the deals around it? And that's the question of whether it's a good deal, because a 1% rule cash flowing property, 12 cap rate property is shit potentially in the panhandle where, there's some good deals selling at 20 cap rate, right? So maybe a 12 is terrible if everything around it is selling at 20. But if you get a 12 cap rate property in Toronto where the average is in Toronto, it's 3%. It's like, okay, then that's a unicorn deal and it's amazing. And you should definitely take that down, right? So it's contextually relevant. Thanks, Vern, appreciate it. Is Jesus that you? Thanks, Welsh guy. Oh yeah, I've been growing it out. My hair is like gotta be like almost a foot long. Like this is hair at the back of my head right now. You can see it's like, yeah, I should get a haircut actually. I really should, but I've just been enjoying it. I've been enjoying it long, letting it grow. It's been a couple of years now since COVID. I think I've been growing it. Or no, I cut my hair towards the end of the COVID lockdowns, but I've just been letting it grow and been enjoying it. And again, like, who do I have to please? Surfer dude. Like, I'm living my best life. I got no boss. My investors don't care what length my hair is. They care if I can perform at what I do. And I don't even have that many investors. They're friends. So like, it's all good. I was gonna go for Jesus for Halloween, but then it was too cold. Stuff built after 2018 isn't rent controlled. Kron, that's true. I've shared that several times now. It's in Ontario, that's a special thing. That the problem is when you buy newer stuff, you pay a premium for that in Ontario. So if you pay a premium, you get that. Port City says CAD is officially a meme coin, or should I say a shit coin? You know, the thing is, Canada, like, don't panic, guys, because Canada can only go, the Canadian currency can only go so low. Canada is one of the largest countries in the world in pure landmass and under, like, our natural reserves for all of the minerals and things like fresh water that actually matter. We have the most of it. Some of the largest reserves in the world. So we are a very rich country. We could actually be a communist country and be okay. It's very rare that a country could be full communist and actually be wealthy. You have to be naturally resource rich, which we are. So as much as I hate that the left is pushing for communism, you know, not real communism. I shouldn't use the word communism. It's really like a socialist, you know, type of democratic government. But that could actually work in Canada because, again, we're so rich. And so, yeah, Canada just, it's such an undervalued stock. I love Canada. I think over the long term, Canada has so much potential, just horrible management, horrible management policies right now. And yeah, they're in a rock and a hard place. You're right. There's a very good point about that. Like if they don't drop rates soon, Canada is downright fucked when it comes to their business, GDP, and but one of the largest drivers of GDP is real estate. It's just not good right now. You know, stuff is not selling, and there's a lot of pain. They're going to have to potentially lower rates before they hit target. That's a real risk. There's a lot of pain. Our big five banks may fail. There's actual risk that, like, Bank of Montreal may fail. A lot of their mortgages are underwater. Their book is losing hundreds. Their books are losing hundreds of millions right now. Default rates are starting to rise. The government, what could happen though, is government of Canada could lend Canadians money. They could stimulate. And that would be opposite of what the Bank of Canada is doing and would put pressure on inflation if you give people money. What would be nice is if they came with policies like, I've been praying for this one, but Bank of Canada needs to remove the stress testing rules. They're not necessary anymore. Right now you have to qualify at the current rate of your mortgage, the term maximum rate for that term, plus 2%. Ridiculous. If you get rid of that, it would be a lot easier for Canadians to borrow. It would make things more reasonable. The government could step in and subsidize mortgages for first-time buyers or for buying a primary residence. If they did that and they subsidize rates by 25%, and our mortgage rates are like 6% right now. We're actually much cheaper than the US right now for mortgages. And if they were subsidized that down to 4%, it wouldn't be that expensive. They could do it, 4 or 5%. Everyone would be fine. If they did that, they printed a bunch of money. The Bank of Canada could keep rates high and even match the US while the Fed is doing that. So they could print. Now, that would result in a need for additional tax revenue. So it would drive taxes up. I don't want that necessarily to happen, but I prefer it to the alternative of real estate collapsing and the banks collapsing. They would have to then bail the banks out, which would be more expensive. This is actually a cheaper solution that could work. So those stress testing rules, it was smart. They put that policy in place because when rates were 2%, we needed to be able to qualify at 4.5%. They stress tested Canadians. That was important. It's why our world hasn't exploded entirely, right? It's because we had those stress testing rules in place, but they're not necessary now when rates are this high. Again, we're getting close to the peak, I think, for how high rates can be with how indebted the average person is per capita, how indebted the government is, just in general. Oh, we got a super chat. Thanks so much. Can't super chat real money. Just saying it's like fake money. There you go, Port City. Check it out. I'll be ecstatic when Pierre takes over leadership. We need some sort of economic common sense. We do, we really do. Totally true. Bitcoin 49,000 Canadian today. Gold stocks are down 50%. I think you mean up. Gold's rallying right now. I don't know how gold would be down. Home values can't drop if demand never weakens. Demand is very weak right now. It is a challenge, I think, that what we're seeing is rental demand is really strong. A lot of people who are going to be home buyers, George, are not home buyers anymore. Where they could have bought a $300,000 house, now it's actually cheaper for them to rent. It's less per month. And they're like, geez, I only make 50 grand a year. I can't go out and buy a $500,000 house. At 3% interest, I could. At 6%, I just can't qualify. So maybe people want to buy, but can't. And there's a lot of those people who want to buy right now we're afraid. The other thing is Americans they like risk. Canadians don't. We are very, very conservative, and we are very much a collective mind. And the sentiment right now, when you go out to dinner with Joe and Sally, is like the market is not doing well, prices are falling, rates are high, fear is maximum. And when fear is maximum, all Canadians get together and like, we're all just going to wait. We're conservative, we're cautious, we don't want to take a lot of risks. So that's the Canadian market in a nutshell. And that's why nothing's selling. There's just nothing selling right now. And the people who do sell are selling for big discounts to try to create liquidity, because real estate is very hard to get liquidity. But yes, people need to go out and vote. True. Yeah, people don't vote. Good point. Government is clueless to any policy, zero economic knowledge in cabinet. Joe says buy more Bitcoin. Definitely. I love Bitcoin. I'm a Bitcoin holder. It's not a large percentage of my net worth. I prefer real estate to Bitcoin, but I will always keep a few Bitcoin just because I'm a believer until 100,000 a token. And at that point, I'll reevaluate. Plumber. Right on, Joe. Converting some Bitcoin gains to gold, a good idea. I like Bitcoin over gold. I like that you can stake Bitcoin, or you can get a yield on Bitcoin by parking it simply. There's risk though, not your keys, not your crypto. So probably store your Bitcoin on your ledger, or you have full control and they can't touch it. If you hold the ledger, no one else holds those keys, just you. So it's important. I think that's another thing I like about Bitcoin, is that it has that digital advantage. You can pick up and move $1 billion of Bitcoin on a USB, effectively like a USB drive, right? And gold is hard to store. It's expensive to store, especially at large amounts of capital. Like I'd have to fill a room with gold. If I wanted to put all my investments in gold, I'd have to like fill like a room with gold. Like what? But Bitcoin I can store in a small amount of space. So it's just easier. It's harder to steal. A number of reasons why I like Bitcoin. It's a finite supply. I think it's going to rally in 2024 when rates start to fall, but we'll see. I am bullish. I think we will see 100,000 Canadian a token of Bitcoin. It will happen in the next 5 years. Oh, and there's the Bitcoin ETFs that are coming, so there'll be a lot of capital inflowing. Do you plan on getting U.S. citizenship? No, I don't. I may get an E2 visa to allow me to work there, but I don't ever want to be a U.S. citizen and pay tax. The U.S. taxes you wherever you go. I will never be in the U.S. more than 4 months. If you stay in the U.S. more than 4 months in a calendar year, you are no longer an alien. I want to be a tax alien. I don't want to be a resident, because the U.S. government takes a cut of wherever you go unless you renounce. So you don't want to have a U.S. passport. I want a Canadian passport, and then guess what? I go to the Bahamas and I pay no tax. Canada only taxes you if you reside in Canada. You can keep a Canadian passport, come back to Canada whenever you want, come back to Canada, start paying tax, get free healthcare. But you can leave and pay no tax. The U.S. is going to take tax even if you leave to Costa Rica, even if you leave to Panama, if you leave to Bahamas, Dubai. The U.S. will still take a portion. You got to renounce. So I do not want a U.S. passport. It makes it challenging for sure for financing. They would prefer. So I look for partners. That's one solution. You look for partners who are U.S. citizens and put them in the corporation with you and put them at 50.01%, and then actually have a real agreement that you own a larger percentage, whatever. Like there's lots of ways you can do this to structure it so you're protected and still able to get good financing. The foreign national rates are like 1% higher. So I don't know. Does the tax mitigate? It depends. But yeah, you still pay tax in the U.S. If you operate a business, like a hotel or a building there, you'd still pay tax. In theory, you could have like a Dubai corp own a U.S. corp that owns the real estate and pay your tax and file in the U.S. as a U.S. entity. Have you heard of Zero Value Realty? It's a full cashback real estate service. No, I haven't heard of them. That's kind of cool. I think in the larger multifamily space, there's some real value in paying to work with pros. And to get deals done a lot of the time, you need to have, you really do need to have, someone message me that though, Zero Value Realty. Someone send me a DM on Instagram for Zero Value Realty. I want to look into them. There's probably a few more. If you know of others, send them to me too, because I like to do a post about that, because people don't, recognize, and some transactions the realtor brings no value. And if it's like a generic MLS single family house sale and you've done tons of those, you don't need any help, any coaching, any experience from the agent. There's no value in that. But sometimes the agent brings a lot of value on the buy side. And sometimes the deal won't happen at all if you try to go with one of those brokerages. The other realtor won't even work with them. The selling realtor, a lot of these off-market multifamily buildings, they transact off the MLS. So a lot of the buildings just are like, the agent gets a call from someone they know. He's like, hey, I want to sell the building. He's like, hey, I know some people. He calls agents he knows and says, hey, I got this building. Do you want it? That's how it happens. It's quietly passed around to their inner network. If you're not part of that network, you're going to miss out on it. And for sure, using a zero value realtor, they're never going to call. Sometimes you have to let that agent who's calling double end it. By double ended, I mean they take the list commission and they take the buyer side commission sometimes. And you do that to get the deal done. So sometimes paying to play, it works. And if the deal's strong enough, you don't care about 50 or 100 grand in commission. You let that go. But I'm all for that. Like, I've done the cashback thing. I've cashed back clients before, if it's a 2% commission, I split, 50% of it as a cashback. I once had, situations where the furnace broke and I replaced it. A pool pump broke and it's like $4 grand. Again, paid for it under my commission, no problem. A good realtor will do that. You don't need to be cheap with your clients. If you give to someone the cashback or whatever, you get it back. So there's a time to be cheap and there's a time not to be cheap. And some on services where it doesn't matter, you can negotiate the hell out of it. Like if you're talking about like painting your building, it doesn't matter if you pay the guy $30 an hour or $80 an hour or $20 an hour. For the most part, the lower you pay, the better it's going to be. In general, for your bottom line, the paint gets rolled on the same way. There's not a huge difference. Some skilled trades, you gotta hire the best, but there's a lot of general labor stuff where you can pay guys 14, 15 bucks an hour to do manual labor, like demo, whatever, basic, easy stuff, carrying materials in, where like, again, that's where you can maybe negotiate on the price, or like a basic single family house that you've done 20 of them before and you don't need the help of a realtor, then maybe using one of these services would make sense. So it depends is the answer I give you. Not always true. An hour of Mike speaking is worth more education than a weekend with a real estate course. Joe, that means a lot, by the way. Thank you guys for that. I've had that. People say that, like, hey, I bought a course for $1,000, and like Mike legitimately in like 3 1-hour sessions on the Wednesday live that I do for an hour, sometimes it's an hour and a half. I get more value from you in those than I got from the $1,000 course. So like what I should be doing is like recording these. This is be low hanging fruit. I could set up a Zoom link for all you guys, let you guys join in for like $10 a month or something, record those, and the people who missed those recordings, I could sell them as a course. If we got really, like I would have to structure it so like, each module is doing something. Like I would have like a, a financing module for multifamily, a deal sourcing, several modules, and each 1-hour class every Wednesday, we would focus on a specific topic and you'd ask questions about that specific topic. But I could easily turn that into a course and make tens of thousands of dollars doing that. And it's low hanging fruit. I should do it. I'm just focused on so many other things right now. You're right. I thank you for the comments. Appreciate it. How long will it take to turn over the units? Probably 1.5 years in total. We're going to do batches of rooms really quick. And then, I could probably get it done in like 12 weeks if I went really hard with a huge crew of 40 or 50 people, but I'd probably do it in stages, in sections, and replace the worst rooms first, of course, get it operating. You don't want to shut the whole thing down. Ideally, you want to do it in stages so you can have cash flow. But it's a good discussion, something I'm thinking about. How do we phase in the changeover? For sure. I think a rebrand right from the start is what we're going to do. We're going to drop the old flag and go with Choice Hotels and switch over. But yeah. Congrats, Mike. Gonna kill it. Thank you so much for all the positive feedback, guys. Really appreciate y'all. Okay. There's definitely things you can do with cost segregation for sure. Totally, you can do all that kind of stuff. There's a lot of stuff you can do with that. What's your best right now? It depends. There's lots of different, it's like Trezor and Ledger and a bunch of other hard wallets you can use. Building portfolio. Thanks, guys. Appreciate it. Appreciate all the stuff, all the comments. Thank you, guys. I'm gonna wrap the stream up because I've been on this for more than an hour now, and it is 8:16. My kids are already in bed. I gotta go do bedtime routine. So thank you guys so much. We'll see you guys next week. As always, you know where to find me, rosehartcapital@gmail.com if you're interested in joining in on what I'm doing, funding some of the deals. I offer a 10% fixed return and I double your capital over a set period of time. So there's a buyout where you get an equity sweetener with it. I can't technically say that, I'm not soliciting capital. So if that's something that you have found with other investors, cool. I'm not soliciting capital right now. I can't do that because, again, I don't want to have legislation, compliance, memorandums, all that to go through and deal with. So anyway, place to find me, Mike Rosehart on Instagram, @Mike Rosehart, and same with Facebook. Look for the blue check mark, and I'll see you guys next week. You guys know where to find me, on here, live, every Wednesday, 7 to 8 p.m. Eastern Standard Time. If you're watching this and you haven't hit the like button, please hit the like button. It lets the algorithm know that you got some value here. It's like when someone presents, they stop presenting and you clap. The like button is the clap. I'd appreciate it very much if you did that. And if you really did get some value here, and it is as great as you say, please take the link, Go onto Instagram, share the link, say, hey, I was watching this tonight. It's fantastic, a lot of great content. Share it with your network. I'd appreciate it. It means a lot to me. Tag me at Mike Rosehart. If you do that, I would be happy to repost you as well for sharing me. So thank you guys so much. Appreciate it. And as always, the secret to unlocking a wealthier you is 3 levers in control of your financial future. Spend less, earn more, and maximize returns in the difference. See you guys next week. Oh, and I've been working out, guys. Check this out.